If you're interested in passively investing in a syndication, we'd love to have a conversation with you. Our investment company is called Nighthawk Equity. Head over to nighthawkequity.com, click the join button, and you schedule a call with us. And it is now a magical time to find deals right now because things are at a discount. And we're going to talk about the difference that's going to make with some of the debt sources that we have. He who has the right debt will win today. So if you're interested in passively investing, check us out at nighthawkequity.com. Also want to do a shout out to Erica, who left us a review on Amazon for the Yellow Book. She says, this is the first book of real estate investing that I read. I acquired good knowledge about the subject. I think it gives you good steps and tips for how to make a deal. Thanks so much, Erica. I really appreciate that. And with that, let's bring in our co-host, Garrett Lynch. Garrett, what's going on?
What's going on, Michael?
So I referenced some of the debt options. What happened after COVID, of course, is that bridge lending essentially went away. And we were all using bridge lending for value add deals, and all of a sudden that went away. So it took a minute to find some alternatives. And once we did, we picked up two great deals since then. And it's the same thing right now with the interest rates and the volatility around that, maybe some uncertainty around an upcoming recession. People are trying to get out of their apartment buildings because, they want to, sell at the top. Now the top was already in March, and we've already come down considerably. I would say the pendulum almost swung a little bit too far to the other extreme. And so we are sensing opportunity, but we got to get the debt right? Because the main issue with the bridge debt is that the interest rate locks that we bought got so expensive that it simply wasn't affordable. So these bridge loans had floating rate debt, which sounds bad. The main advantage of them is that you have a flexible exit. You could refinance whenever you want. You can sell whenever you want. And with fixed term debt, you are very limited because of the yield maintenance and the prepayment penalties. So we loved floating rate bridge debt, but and then we bought these interest rate caps that capped how high the interest rate could go, which is great. But 6 months ago, they got really, really expensive. So like, man, we can't do this anymore. The deals don't work. So as a result, no one's using bridge debt anymore. And so, Garrett, what are we seeing out there that might provide some alternatives here?
Yeah. So, these are things you need to pay attention to when the market shifts. And the best way to get a really up-to-date purview of what's coming is to have a really good mortgage broker that you can call on and ask them, hey, what are you seeing in the market? You can talk to brokers as well. Hey, what are you seeing in the market? And so what we're finding is that a lot of the bridge lenders have come off their leverage amounts, and their spreads are getting bigger, meaning your interest rates are going up, essentially for bridge debt to a point where it's not as attractive at all to use it. And we saw a similar shift in 2020 where it went away completely. And then we found another product and we used that to buy. And it was a little bit more painful to go through the process of purchasing because we had to raise more money or whatever, but it ended up paying off. So right now, a really good option that you can look for is, and you can look through your mortgage broker or call around, is look for regional or local banks that will issue maybe a partial recourse option or a burn down option. So I don't love the idea of going into a full recourse situation necessarily, because it does erode your net worth on the balance sheet. But if you get something where there is like a potential for partial recourse, you could potentially trade that in for better options, higher leverage or a better interest rate or something like that could work out really well in your favor, allowing you to be a little bit more competitive when you go out and try to buy deals at a discount. So that's really a great option. Credit unions, regional, local banks.
Now, these credit unions, regional banks, I mean, traditionally they've been full recourse, right? So are they softening up? Are you seeing that they're willing to negotiate? And if so, what are some of the terms of those negotiations?
Well, they're getting a lot of attention right now. So, it's with them, it's more of a handshake and a relationship type situation. So if you start with the places you already have relationships with, see if there's any options that they'll work with you on. And if they say no, then you can start to seek out those other relationships until you find someone that gives you the option you're looking for. Most banks are going to be recourse, like local banks, regional banks, full recourse. Now, some of them do have options for other ways around that. And so that's what you really want to find are, hey, where do those exist? It could be a little bit like finding a needle in a haystack, but you only have to find one. When you find one, you can go on a run with that person and then just continue to use them for your debt option. So that's really just doing the initial legwork up front to check around, see who's going to give you that type of option, and then run with that is going to be a really good strategy for right now.
Yeah, I mean, this is kind of what happened after COVID. We got into these credit unions, and they were fantastic to work with. The terms were amazing, no prepayment penalties, super low interest rates, really nice to work with, very flexible. Like you talk about the personal relationship. The only downside was the requirement for full recourse. So we're talking to several of those credit unions and also regional banks, which is new for us, right? Because normally we go to bridge lenders or government backed, Fannie Freddie kind of loans. So we got a little bit lazy, well, because we didn't have to, but now we do. And so, now is a good time to get great debt so you can get into these deals. But also what happened to COVID when we had to switch loan products like everybody else, what happened is the prices went down because now, you had to put additional escrows in, and you have to put additional money, interest escrows into escrow. And you also you couldn't finance the construction anymore. So because that bridge loan went away, the underwriting changed. And so therefore the price went down. And that's kind of what's happening right now. And sellers, the sophisticated ones, understand it. And some of the less sophisticated ones they're going to take a minute. But just like with COVID, they might get there within 4 or 6 weeks when their broker keeps telling them, hey, the market is not what you think it is now down here, and here's why. So it's just a matter of time to educate the sellers. And if you can do that, then you have the inside track on a particular deal. And that's kind of what we're seeing again. So therefore, we think there's a lot of opportunity there.